Coester's relationship with the mortgage banking industry is something that we value dearly. We attend all the industry events. We go to the nationals and the local MBAs. We attend the American Bankers Association conferences, and it's something where we're really not just a part of the industry as from a vendor standpoint, we're really a part of the industry from a truly advisory and also a legislative help standpoint. We consider the mortgage industry like our partners, where we understand your business, we understand what you're going through with all the legislation, and we provide help. I mean, we really do. Our webinars have over 50,000 views. Some of the things like our weekly newsletters and our white papers on advisory opinions for legislation really are designed to help and assist the mortgage bankers with complying to compliance, helping with getting their business on track to make sure that when they're audited, they have all the necessary documentations that they need. The flexibility of having it kind of in-house, but also the security of dealing with a national reputable appraisal management company.
Their appraisal group. Thank you. I just wanted to notify you that the time is now 2:00 p.m. Eastern Standard Time, and we do still have a few attendees filing in at this moment. So we're going to give it a couple of extra minutes before we get started with our presentation. So if you could please stand by, we will be back shortly. Thank you so much. Hey, Brian?
Yes.
Is that you breathing into the phone?
Probably. That's usually me.
Okay. Yeah, I was going to say, can you take a step back? Someone just, yeah, take the phone away just a little further back. Yeah, okay. Much better. Thank you.
So the people are coming. There's about 300. Give it a couple. I mean, like maybe 202, and then I'll turn it over. Fed, I'm going to turn it over. Crystal's going to turn it over to you. We'll turn it over to you in about 2 minutes.
All right.
All right.
And pick up on 19. So, I don't know if I can get it.
All right, Crystal, go ahead and get started.
Okay, great. All right, once again, thank you all so much for joining us today for our webinar here at Coester Appraisal Group. As I mentioned, my name is Crystal Witherspoon. I am the Director of Client Vendor Relations for Coester Appraisal, and I will be the moderator as well for this webinar today. Just to get started, I'll go ahead and give you a few pointers for all of you that are joining us. If you go ahead and direct your attention to the GoToWebinar panel that appeared once you signed into the webinar, you will note that there is a chat section in there. If you all have any questions during any point of the presentation, please feel free to send a message to us with that question, and we will address it at the end of the presentation. These all go directly to me, so I will make sure to try to get as many of these answered as possible. Also, I'll go ahead and give you a little more information about the treat you are in for today. The name of the webinar that you are attending right now is called HARP 2.0, Music to Distress Borrowers' Ears, or Sound and Fury, Signifying Nothing. This is hosted by Brian Coester, our CEO of Coester Appraisal Group, as well as, I'm sorry, I lost my train of thought here, as well as two employees from Weiner, Brodsky, Sidman, and Coester PC. They are a Washington, D.C. based firm with a national practice focused on compliance, regulatory, transactional, and litigation matters related to financial services and transportation concerns. They have a wide variety of clientele that they serve, anywhere from financial institutions all the way to banking companies and transportation companies as well. So definitely have a lot of expertise on the topic for you all today. So I'll go ahead and let them introduce themselves as well as provide a little more information about their background. And I'll go ahead and hand it over to our first speaker, Fred.
Hi,
Okay,
Fred, are you
thank
there?
And I'm going to go ahead and make Fed the presenter. To everyone's point, we've got some great, if Jim Milano and Fed Kamensky are two of the best in the business as far as when it comes to compliance, and their law firm out of DC deals with really all the the best in the industry. So we're very, very excited to have them on board and really going to present some very valuable information. We've had over 1,100 people registered. There's about 500 people on the conference right now, and they're just piling in. So we're very excited. This is an industry kind of changing thing with this HARP, and there's a lot of confusion out there. So I'm going to turn it over to Fed right now as a presenter, and we look forward to seeing it.
Thank you, Brian. This is Jim Milano and Fed Kamensky at Weiner, Brodsky. And we are just going to try to get some technicals up here. I hope everyone can see our screen. We're now on slide 2. Just a quick introduction again about our firm. We are a mortgage banking regulatory compliance firm. We also do defensive litigation and transactional work. Our practice is national in scope. We help folks get licensed in all 50 states. We do the alphabet soup. We're very busy right now with administrative enforcement action defense, but also handling transactions, changes of control, that type of thing. We do work for appraisal management companies, and you can find out more about us at our website. We'll have information on the last slide of this presentation where you can find out more about us. We'll have time for questions at the end. The topics we're going to cover are outlined here on the second slide that we're looking at. We're going to try and go through our presentation in about 40 to 45 minutes and leave time for questions at the end. But if anyone has any questions after the webinar, feel free to reach out to the folks at Coester Appraisal or reach out directly to us. We'd be happy to receive questions that you bounce off of us. Now, the topics we're going to go over today are the general HARP requirements, the original HARP requirements. We'll call it HARP 1.0, and how HARP is administered by the government-sponsored enterprises, Fannie Mae and Freddie Mac. The highlight of today is going to be the important changes announced in late October of 2011, what we're calling HARP 2.0. And then we're going to talk about what the future might hold, as alluded to or indicated by President Obama in his State of the Union speech. Perhaps we're looking at a future potential of HARP 3.0. A couple of things to remember. Right now, the HARP program applies only to GSE loans, Fannie Mae or Freddie Mac loans. There are 2 HARP programs. There's the Fannie Mae HARP program and the Freddie Mac HARP program. Each GSE has different versions of the HARP, and we'll talk a little bit about that today. The important changes were announced in October, and we're going to go over those in detail. And the effective dates may vary. Some changes are not effective until later next month. So remember, HARP is Harper Technical. That's our little regulatory compliance joke for you. So this is the world according to HARP. The Home Affordable Refinance Program, or HARP, is a federal program that allows borrowers to refinance their existing mortgage loans even if the borrower owes more on the current home value of their loan, the so-called underwater borrowers. As we said, HARP was originally introduced on March 4, 2009 as part of a broader Obama administration program, the Making Home Affordable program. And as you know, there were other programs available to borrowers under the MHA program. You've heard of HAMP. Everyone knows about HAMP, the Home Affordable Mortgage Program. Along with that, the Second Lien Modification Program, the Home Affordable Unemployment Program, and the Home Affordable Foreclosures Alternative. Important new changes designed to expand borrower eligibility for HARP were announced by the Obama administration on October 24th, 2011 through the FHFA, the Federal Housing Finance Agency, the oversight agency for the GSEs, Fannie Mae and Freddie Mac. And the objectives of HARP include the following. borrowers with negative equity in their homes are often
Ted?
unable. Yes.
Hi, I'm sorry to interrupt you. I'm getting a lot of feedback from the chat section that no one is seeing the changing of your slides. They're
Okay,
still
we
seeing
are
the
on
introduction.
Can you see now?
I'm having no problem seeing it, but a lot of people are still saying that they're seeing the welcome screen.
Okay, well, you turned it over to us. Did you guys email the slides out as part of registration?
Okay, yeah, okay, we're getting more feedback saying that people can see it now. So
Okay.
I'm sorry about that. I just wanted to make sure people were following.
So we're on slide 3, and we're talking about the objectives of HARP. And the objectives of HARP, again, include borrowers with negative equity in their homes that are often unable to refinance through other available programs. HARP provides an opportunity to refinance to borrowers who've been making timely mortgage payments, but who are unable to refinance because the property values fallen. HARP enables borrowers who owe more than their home is worth to take advantage of current low interest rates and other refinancing benefits. HARP puts responsible borrowers in a better position by reducing their monthly payments, lowering the interest rate, shortening the amortization period, or moving to a more stable product, such as from an interest-only mortgage to a fully amortizing fixed-rate mortgage. From its inception in March of 2009 through January of this year, almost 1 million borrowers have been refinanced through HARP. But as we're going to talk a little bit about later, the goal of HARP was to refinance approximately 4 to 5 million borrowers by June of 2010. Obviously, that did not happen, and we'll talk a little bit later on in the program whether HARP 2.0, the new, most recent version of HARP, will live up to its billing, or will more be needed to prompt underwater borrowers to refinance. We're now on slide 4. We're going to talk about the general eligibility requirements. The general HARP eligibility requirements include that the original borrower that's being refinanced, the loan, the original mortgage that's being refinanced, must be owned or guaranteed by Freddie Mac or Fannie Mac. Accordingly, participation in the program currently is limited to GSE loans only. And borrowers can find out if they have a Fannie Mae or Freddie Mac loan by looking at the websites of the particular GSEs, Fannie Mae or Freddie Mac. The original mortgage must have been sold to Fannie Mae or Freddie Mac on or before May 31st, 2009. For example, a mortgage loan must have been purchased by a GSE prior to June 1st, 2009, or placed in a pool with an issue date prior to June 1st, 2009 to be eligible for a HARP refinance. Mortgage loans purchased on or after June 1st, 2009 are not eligible. And the mortgage cannot have been previously refinanced under HARP, but there is one exception from this requirement for Fannie Mae loans that were previously refinanced under HARP from March to May of 2009. The borrower's current LTV ratio must be greater than 80%. In other words, for a HARP refinance, the borrower must owe more than 80% of the current market value of the property. To clarify this point, both Fannie Mae and Freddie Mac offer other refinance options for borrowers who owe 80% or less on their current home value. However, such low LTV loans will not qualify for a refinance under HARP. In order to be eligible for HARP, the loan must be a first lien loan. Second mortgages are not eligible, and also loans that are subject to outstanding repurchase requests are not eligible. Okay, we're on slide 5 now. We're going to talk a little bit about the mortgage payment history requirement and borrower benefit requirements under HARP. The borrower must meet certain mortgage payment history requirements in order to qualify for a refinance under HARP. More specifically, the borrower must be current on the original mortgage at the time of the HARP refinance with a good payment history in the past 12 months. Under HARP 1.0, the original HARP, delinquency requirements depended on whether the payment is increasing or decreasing following the HARP refinance. However, HARP 2.0 revised these requirements, and the borrower may may not have any delinquencies on an existing mortgage in the past 6 months and may have no more than one 30-day delinquency in the past 12 months. In addition to the payment history requirements, there's a benefit to the borrower requirement under the HARP program. The borrower must, essentially the underlying requirements is that the refinance transaction must assist the borrowers and help ensure long-term sustainability of the new loan. The lender must represent and warrant to Fannie Mae or Freddie Mac that the borrower is receiving a benefit from the refinance transaction. The borrower must receive a benefit in the form of at least one of the following: a reduced monthly mortgage principal and interest payment, or moving to a more stable mortgage product. Under HARP 2.0, a reduction in the interest rate and a reduction in the loan amortization term were added as eligible benefits to the borrower. Just more along the lines, we're on slide 6 now if you're following along, more along the lines of borrower benefit requirements. Some of the examples of moving into a stable product include the following: refinancing from an ARM to a fixed rate mortgage, moving from an ARM to a new ARM with a lower initial fixed period of 5 years or more, refinancing from an interest-only feature to a fully amortizing mortgage, refinancing from a 30-year fixed-rate loan to a fixed-rate loan with a shorter term, 15, 20, or 25 years. By way of more examples, note that the extension of the amortization period is not considered movement to a more stable product unless it results in a reduction in the principal interest payment. Similarly, moving from a fixed-rate mortgage to an ARM is not considered moving to a more stable mortgage product unless there's a reduction in the principal and interest payment. Okay, we're on slide 7 now. We're talking about property eligibility and occupancy. Under HARP, eligible properties include 1 to 4 unit primary residences, second homes, and 1 to 4 unit investment properties. All property types are eligible, including condos, co-ops, manufactured homes, and homes and planned unit development. There's no requirement that the occupancy remain the same. The occupancy of the property may change between the original mortgage and the refinance transaction. In addition, a borrower may be removed from the new loan if the remaining borrower has been making payments from his or her own funds for the past 12 months, unless they were removed due to death, and the borrower being removed also must be removed from title. With regard to subordinate financing, all existing but not subordinate liens or loans must be resubordinated to maintain the first lien priority of the new refinanced HARP mortgage, which is in first lien position. New subordinate financing is not permitted in connection with a HARP refinance. Thus, essentially, borrowers may not pay off their existing subordinate liens with the proceeds of a new HARP refinance loan, but must instead resubordinate that loan to the new HARP loan. Borrowers also may not obtain new subordinate financing in connection with the HARP refinance. In addition to those requirements, there are employment verification and ability to repay requirements. The lender must obtain at least a verbal verification of employment and verify the borrower's source of non-employment income, if any. For Fannie Mae Desktop Underwriter or DU Refi Plus loans, lenders also must follow the employment documentation required by the Desktop Underwriter. On December 20th, 2011, Fannie Mae updated its HARP guidelines by removing the reasonable ability to repay language. Fannie Mae explained that lenders are no longer required to determine the borrower's reasonable ability to repay as part of the application for a refinance loan. Accordingly, the borrower's ability to repay with the new refinance loan is based primarily on the following determinations. The borrower's acceptable payment history on the existing mortgage, which we've already discussed, and the borrower receiving a benefit from the refinance transaction, which we've also already discussed. However, note that certain requalification requirements will apply if the borrower's payment increases by more than 20%. And we'll go into those requirements later in the presentation. Before I turn it over to Fed, I just want to indicate a couple of areas we're going to note. There's additional requirements outside of HARP that lenders need to be aware of. One of those is the current ability to repay requirements under Reg Z for higher price mortgage loans. That Reg Z requirement still applies. For first lien loans, if the APR exceeds 1.5 percentage points in excess of the average prime offer rate, then the lender must verify the borrower's ability to repay under Reg Z requirements. Now, 1.5 percentage points over the average prime offer rate may sound high, but remember, the average prime offer rate is very low, and it's an APR measure, so you have to take into account the interest rate and the points and fees and come up with an APR calculation and compare that to the average prime offer rate. That's the first point we wanted to make. The second point is the Dodd-Frank Act changed the Truth in Lending Act to put in ability to repay requirements and exception to that for qualified mortgages. The Federal Reserve Board proposed that rule last May, and the Bureau has inherited that rule, and we're hearing going to come out with a final rule that's going to have an ability to repay requirement that's going to apply more broadly than higher price mortgages. We expect that rule to come out in final form later this year. So as you move into this program as a lender and look at it, just remember there are other requirements, and we'll talk about some of those other requirements besides ability to repay as we go through the presentation. Let me turn it over to Fed.
Well, thank you, Jim. And as Jim mentioned, HARP can be very hyper-technical. So in the next 10 or 12 slides, we're going to go over these hyper-technicalities, or maybe I should say hyper-technicalities. And on the next slide, which is slide 8, I'm going to go over how Fannie Mae and Freddie Mac administer HARP. As Jim mentioned, essentially there are two HARP programs, Fannie Mae HARP and Freddie Mac HARP. Fannie Mae administers HARP through its Refi Plus program, and there are two separate options available under Fannie Mae's program. There's the Refi Plus, which is the option for manual underwriting, and there's also the desktop or DU Refi Plus, which is an automated underwriting option. With regard to Refi Plus, it's important to note here that the lender originating the refinance loan must be the current servicer of the existing loan that is being refinanced. So, in other words, for the manual underwriting option, HARP loans may be offered only by the borrower's current servicer. The borrower may not obtain a HARP refinance under the manual underwriting option from a new lender. Also, I would point out here that a subservicer is not considered to be the current servicer for purposes of this requirement under Refi Plus. With respect to DU Refi Plus, the Fannie Mae desktop underwriter option, the lender is not required to be the current servicer. So, in other words, under the DU Refi Plus option, the new loan can be originated by any participating HARP lender selected by the borrower. With regard to Freddie Mac loans, Freddie Mac administers HARP through its Relief Refinance Program, and there are also two separate options available from Freddie Mac. There's the same servicer option, which allows borrowers to refinance through their existing lender, and there's also the open access option, which allows borrowers to refinance through a participating lender other than the borrower's existing lender. Let me note here that Freddie Mac's HARP requirements generally, not always, but generally mirror Fannie Mae's requirements, and therefore in this presentation we're generally going to focus on Fannie Mae's requirements, but we will also point out some of the differences under Freddie Mac's HARP as well. Moving on to the next slide, slide 9, this slide basically summarizes the recent changes under the HARP program. And as Jim mentioned earlier, on October 24th, the FHFA announced significant and important new changes to HARP, and these changes are often referred to as HARP 2.0. In summary, the program enhancements under HARP 2.0 include the following. The program end date has been extended through December 31 of 2013. The borrower's delinquency requirements have been somewhat relaxed. The maximum LTV cap ratio has been eliminated for certain fixed-rate loans with terms of up to 30 years. Lenders are relieved of certain representations and warranties, including with respect to appraisals in certain cases. In addition, in some situations, the lender will not be required to obtain a new appraisal. Additionally, certain risk-based fees that are charged by Fannie Mae for delivery of refinance loans have been removed or reduced. So let me just say here that generally these changes were intended to expand the number of eligible borrowers who can now refinance through HARP and benefit from today's low, I would say record low interest rates, including those borrowers that are significantly underwater. The next slide basically summarizes some of the key dates under HARP 2.0. As we discussed really quick, October 24th is when the changes were introduced. November 15th, Fannie Mae and Freddie Mac issued preliminary guidelines for HARP 2.0. I would note here that both GSEs subsequently issued several amendments to their guidelines and guides to implement these changes, and we do not list all of the dates here. Most of the changes became effective on December 1 of 2011 of last year. There's one important exception here, and that's the removal of the LTV cap, which is not yet available for Fannie Mae's DU Refi Plus loans. We will go into this in more detail in the presentation, but Fannie Mae is expected to update its DU Refi Plus program during the weekend of March 17th to make unlimited LTVs available to borrowers and lenders. I would also point out here that because lenders participate in HARP generally on a voluntary basis, the actual implementation schedules for HARP 2.0 may actually vary lender by lender. And finally, as you see on this slide at the bottom, December 31, 2013 is the program expiration date. In the next few slides, so we're now on slide 11, and in the next few slides, we're going to provide a more in-depth and more hyper-technical analysis of the actual changes under HARP 2.0. With respect to program extension, the program expiration date has been extended through December 31 of 2013. So what this means is that Fannie Mae now requires that the note date be on or before December 31, 2013. Fannie Mae previously required the note date to be on or before June 30 of 2012. So essentially, this amounts to an 18-month extension of the program. Whole loans must be delivered to Fannie Mae on or before April 30 of 2014, or be in an MBS pool with an issue date no later than April 1 of 2014. For Freddie Mac loans, the loan must have a note date on or before December 31, 2013, and must be delivered to Freddie Mac within 120 days of the note date. We're still on the same slide and moving on to payment history. As we noted earlier, in order to qualify for a HARP refinance, the borrower must meet certain payment history requirements. This is essentially one of the key underwriting requirements for HARP 2.0, along with the borrower benefits requirement that Jim went over earlier. And prior to the recent changes, so under HARP 1.0, the payment history depended on whether or not the borrower's payment is going up or down. Under HARP 1.0, if the payment was increasing, the borrower could not have any late payments in the past 12 months. If the payment was going down, the borrower could have no more than one late payment in the past 12 months. With the recent HARP 2.0 changes, the borrower must comply with certain somewhat relaxed payment history requirements. Essentially, the loan must be current at the time of the refinance. The borrower may not have any late payments in the past 6 months now, and the borrower is allowed to have one late payment in the past 12 months. And to put this all into perspective and to give you an example here, basically with these changes to the borrower payment history, and because the program has been extended, some borrowers who currently have one late payment now have the option to bring their mortgage current, and if they manage to stay current for at least 6 months, they could qualify for a HARP refinance. Moving on to slide 12, this slide talks about the elimination of the maximum LTV ratio, which perhaps is the most important and key development under HARP 2.0. And to give you a brief historical background here, as originally introduced, the program imposed a maximum LTV ratio of 105% for all loans refinanced through HARP. So that was across the board. Then in July of 2009, the maximum LTV ratio was increased to 125%, but this increase only applied if the borrower refinanced into a fully amortizing fixed-rate mortgage with a term of 30 years or less. Needless to say, as a result of significant declines in property values, many borrowers who were seriously underwater in excess of 125% could not qualify for a refinance under HARP 1.0 even after these changes in 2009 were implemented. As a result of these issues, the recent HARP 2.0 enhancements removed the maximum LTV limitation for loans secured by fully amortizing fixed-rate mortgages with terms of up to 30 years. So, in other words, the LTV is now unlimited for those borrowers who choose to refinance under HARP into fixed-rate mortgages with terms of 30 years or less. Now, for fixed-rate mortgages with terms of more than 30 years and up to the maximum allowable term of 40 years, there are no changes from HARP 1.0. And these longer-term fixed-rate mortgages remain subject to the maximum LTV ratio, which remains at 105%. Similarly, for adjustable rate mortgages, there are no changes from HARP 1.0, and these ARMs remain subject to the maximum LTV ratio of 105%. Also, I would note here that for ARMs, the initial fixed rate period must be 5 years or more, and the total loan term may not exceed 40 years. To sum up and to give you an example here, after these HARP 2.0 changes, if a borrower obtains a fixed rate 30-year mortgage through HARP, there is no limit on the LTV and no limit on how much the borrower can be underwater. If the borrower chooses an ARM or a fixed rate mortgage with a term of more than 30 years, the borrower may not finance more than 105% of the home value. Moving on to slide 13, here we would just like to emphasize one key requirement for these changes with regard to the LTV cap. And essentially, the removal of the LTV cap became effective on December 1 of last year for loans refinanced under Fannie Mae's manual underwriting option, the Refi Plus, but it's not yet available. The removal of the LTV cap is not yet available for Fannie Mae's desktop underwriter option, and Fannie Mae is expected to implement the deregulation of the LTV cap after the weekend of March 17th. So what this means, in effect, is that until in mid-March, Fannie Mae implements the removal of the LTV cap for the EU Refi Plus option, lenders may offer HARP 2.0 to those borrowers with LTV ratios above 125% only through the manual underwriting option. And here, let me note that as we previously discussed, under the manual underwriting option, this option is limited and is available only to the current servicer on the existing mortgage. So the borrower currently cannot go to a new lender and refinance a loan that's more than 125% underwater, but this will change, expected to be changed in mid-March of this year, so that this change is coming up, and stay tuned. Let me just mention that with respect to Freddie Mac loans, Freddie Mac follows a relatively similar implementation schedule for the LTV removal, LTV cap removal. For Freddie Mac's same servicer option, the removal of the LTV cap became effective for those loans with settlement dates on or after February 1st of this year. And for Freddie Mac's open access option, the removal of the LTV cap will become effective for loans with settlement dates on or after March 15th of this year. So that's also coming up for the open access Freddie Mac option, a definite expansion of the program. Moving on to the next slide, which is slide 14, we're now going to talk about the recent changes to the underwriting representations and warranties that lenders must make when they refinance loans under HARP 2.0. This quite clearly is another key development under HARP 2.0 that's intended to encourage lender participation in the program. And let me just say here that in general, when a loan is refinanced, the lender may be held responsible for the reps and warranties on the original loan. So the transfer of old reps and warranties from the old loan to the new loan carries with it the possibility of repurchase liability, and this is believed to be one of the key deterrents to lender participation under HARP. So what HARP 2.0 does, essentially, is it waives some of the reps and warranties on the original loan for Fannie Mae's manual underwriting option known as the Refi Plus. So to clarify here, more specifically, under the manual underwriting option, under HARP 2.0 changes, the lender is only going to be responsible for the following reps and warranties with respect to the original loan. A, compliance with laws, B, fraud, and C, original project eligibility. The lender will not be required to make other reps and warranties on the original loan that pertain to borrower eligibility and underwriting. To go into even more detail here, as you can see on the slide, on the original loan, the lender must reference warrant that the loan was basically complying with the federal, state, and local laws when it was originated. This includes fair lending, equal credit opportunity or ECOA, truth in lending or TILA, Real Estate Settlement Procedures Act or RESPA, and predatory lending, to name just a few. The lender also must reference warrant that the original loan did not involve any scheme of fraud. Fraud here is defined as a misstatement, misrepresentation, or omission that could not be cured and that Fannie Mae relied upon in purchasing the loan. A scheme or pattern of fraud has its own definition and is basically defined as it needs to involve 2 or more mortgages, and there needs to be 2 or more perpetrators acting in common effort. So what this means, based on these definitions, is that the lender will not be required to make a reference warranty as to fraud at the loan level, but instead must reference warrant that there was no systemic fraud involving 2 or more mortgages and 2 or more perpetrators. And in addition, the last point here is that if the loan involves a condominium, co-op, or a PUD development project, then the lender must reference warrant that the project was approved when the loan was originated. Moving on to the next slide, here on slide 15, we're basically emphasizing that these changes that I just now talked about, these changes to the reps and warranties, they became effective on December 1 of last year and essentially only affect Fannie Mae's manual underwriting option, Refi Plus. With respect to the DU Refi Plus, the desktop underwriter, essentially there are no changes from HARP 1.0, but I'm going to summarize the key provisions with respect to reps and warranties. Under the existing DU Refi Plus guidelines, the lender is not responsible for any reps and warranties on the original loan. That has not changed. That's still in place. In addition, the lender is relieved of the standard reps and warranties with respect to underwriting on the new loan if the following conditions are met. The lender must provide loan data in the DU Refi Plus that is accurate, complete, and not fraudulent. The lender must follow all underwriting guidelines and instructions that it receives from DU Plus, and ultimately the lender must comply with all other applicable requirements in the selling guide. To summarize also for Freddie Mac, similar changes to reps and warranties under Freddie Mac's same servicer option became available on December 1 for Freddie Mac loans with settlement dates on or after January 3rd of this year. We're now moving on to the next slide, and here we talk about appraisal requirements. This also is another important area where developments under HARP 2.0 are intended to allow more borrowers to qualify and to encourage more lenders to participate. Essentially what HARP 2.0 does here is it expands the circumstances under which a new appraisal will not be required for the refinance transaction. Basically, HARP 2.0 expanded the use of AVMs, or electronic valuation models, where a reliable AVM can be provided through the GSE. So by way of a background, under the DU Refi Plus option, Fannie Mae's desktop underwriter option, the loan may be eligible for the property fieldwork waiver. If the loan is eligible and the lender elects to exercise the waiver, Fannie Mae will accept the property value estimate provided by DU, and the lender will not be required to obtain a new appraisal. If this is the case and the lender exercises the waiver, the lender will also not be required to make any reps and warranties as to the value, marketability, or condition of the property. So under HARP 2.0 changes, what HARP 2.0 does essentially is it's going to increase the use of the property fieldwork waiver under DU Refi Plus. Basically, Fannie Mae is going to increase the DU Refi Plus property fieldwork waiver offer rate. I know it's a mouthful. What this means is that there will be more and more loans eligible for the property fieldwork waiver under the desktop underwriting option. This should remove the need for a new appraisal on a going forward basis in more cases. We do not yet have the details regarding the scale of this expansion of the use of the property fieldwork waiver, but Fannie Mae has indicated that the expanded use of the appraisal waiver will be significant. With respect to the manual underwriting option, we're still at the bottom of slide 16. Just to summarize, essentially there have been no changes from HARP 1.0. Under the manual underwriting option, the lender has the following two options. A, the lender can rely on the original appraisal without having to get a new appraisal, but in this case, the lender is required to make a representation and warranty that the current value of the property is not less than the value reflected in the original appraisal. So, the lender is essentially permitted under the manual underwriting option to proceed without a new appraisal if, and this is a pretty big if the lender can rep and warrant that the new value is not less than the original value. If this rep and warranty could not be made, then the lender essentially must obtain a new appraisal for an exterior inspection as may be required, and if the lender obtains a new appraisal, then the lender will have to make the standard reps and warranties on that new appraisal, but would be relieved of any reps and warranties in any prior appraisal. So that has not changed under HARP 2.0. I know it's a lot, even though it's only one slide. Let me just summarize it in one sentence. To summarize, there will be an increase in the use of the appraisal waiver under the DU Refi Plus program, but for the manual underwriting option, the lender must either rep and warrant that the new property value is not less than the original value or must obtain a new appraisal. Moving on to slide 17, here we talk about the elimination of certain risk-based fees and certain changes in the bankruptcy and foreclosure policies. Basically, as an additional incentive, HARP 2.0 eliminates certain risk-based fees for borrowers who refinance into short-term loans. More specifically, if the borrower gets a loan with a term of 20 years or less, Fannie Mae's delivery fees, including loan-level price adjustments, LPAs, and adverse market delivery charges, AMDCs, will be eliminated. If the borrower obtains a loan with a term of more than 20 years, the cap on the total Fannie Mae delivery fees is reduced to 0.75%. By way of a short example, if the borrower has to pay, let's say, 1 point in risk-based price adjustments for delivery of the loan to Fannie Mae prior to HARP 2.0, under HARP 2.0, that amount will go down to 0 for a 20-year loan and to 0.75% for a, let's say, a 30-year loan. Basically, this change is there to encourage borrowers to refinance into short-term loans and thereby to expedite rebuilding property equity in their homes. With respect to this change, it's effective. It's already effective for whole loans purchased by Fannie Mae on or after January 3rd of this year, and for mortgage loans delivered to MBS pools with issue dates on or after January 1st of this year. Now moving on to bankruptcy and foreclosure, there's been an important development in this area as well. Fannie Mae is basically going to waive its previous requirement that the borrower on the new loan must meet the applicable waiting period if there was a bankruptcy or a foreclosure prior to the refinance. Fannie Mae is also going to basically, Fannie Mae previously required that the original loan must meet the bankruptcy and foreclosure requirements when that original loan was originated. Fannie Mae is not going to continue to require this, and these changes are effective December 1 of last year. Moving on to slide 18, here we talk about borrower requalification requirements. This is an important area. Basically, by way of a brief background, as a general rule under HARP 2.0, there are essentially no requalification requirements for the new loan being refinanced under HARP 2.0 as long as the borrower meets the payment history requirements and receives a benefit from the refinance. And we discussed those borrower benefit requirements and the payment history requirements earlier in the presentation. Now, there's one important exception to this general rule, and that is if the borrower is experiencing a large payment increase as a result of the refinance, the borrower must be requalified for the new loan. And here, a large payment increase is defined as a principal and interest payment going up by more than 20%. The borrower must be requalified in this situation, and this means that the borrower's DTI ratio may not exceed 45%. The borrower must have a minimum credit score of 620. The lender must verify the borrower's income, and the lender must verify the borrower's assets if the borrower is required to bring cash to the closing table. Just to clarify here, these requalification policy changes basically apply to the manual underwriting option, because under the DU Refi Plus, the desktop underwriter will automatically perform these valuations. And these changes are effective, they are already effective as of December 1 of last year. Moving on to the next slide, another important area under HARP 2.0, and that's borrower solicitation. Essentially, HARP 2.0 expressly allowed lenders to solicit potentially eligible HARP borrowers for a refinance as long as certain requirements were met. And more specifically, the lender must solicit borrowers with loans owned. Let me restate that. If the lender solicits borrowers with loans owned by one of the GSEs, the lender also must solicit and apply the same activities and techniques to borrowers with loans owned by the other GSE. It's a mouthful. To state it shortly, what this means basically is that lenders must solicit borrowers to the same degree across both GSEs. There is another requirement, and that's the lender must solicit borrowers to the same degree, regardless of whether the lender or a third party owns the underlying associated MBS pool. If the lender makes a solicitation and includes a reference to a GSE, there is a specific disclosure that must go in the solicitation materials, and we provide that exact language in the slide. I'm not going to restate it. I'm only going to note that this borrower solicitation requirement is already in effect. It was in effect as of December 1. And now I will turn this over back to Jim, who is going to talk about some of the recent developments that go beyond HARP 2.0.
Thank you, Fed. Before we get into what may be coming down the pipe, just a couple of numbers for folks. Between 2004 and 2006, and we don't have these in your slide, but upwards of 40%, from a third to 40% of the mortgages being originated were private label securities, non-GSE loans. And that's from information that the FHFA puts out, the Federal Housing Finance Agency. In 2007, that number went down to 9%. So the rest of the mortgages being originated were GSE loans, and in 2009, FHA made up 3.4% of originations. It was much less than that prior to 2007, and went up after 2007, FHA loans. Another statistic from the FHFA, in 2009 and 2010, HARP borrowers that refinanced from a 30-year fixed-rate mortgage into another loan of the same type reduced their interest rates by about 1 percentage point on average. And when you look at the interest rates from 2001 to January 2012, when you look at 2005, 2006, 2007, the rates were in the high 5s and mid to low 6 percentage points, and went down to 5% in 2009. In January 2012, the average prime offer rate was around 3.92%. Now again, that was for LTV ratios of 80%. With qualifying borrowers on conforming loan amounts. My point of all these statistics are, on a 30-year fixed-rate mortgage of $250,000, assuming a 5% note rate and assuming property tax of 1.25%, the monthly principal and interest and tax and insurance payment would equal about $1,650. To get that payment down to less than $1,300, there's going to have to be a substantial decrease in the interest rate and perhaps even some principal reduction. And the other thing we haven't talked about is the closing cost. On average, closing costs are about 1% of the loan amount, and that, according to a study by Fannie Mae's economist, is one of the headwinds or impediments to borrowers refinancing, that they have to pay closing costs. So it's no surprise that right on the heels of the announcement of what we're calling HARP 2.0, the Obama administration comes out with more announcements on broad-based plans to help borrowers who are underwater. So President Obama announced a proposal for a new refinancing program dubbed the Broad-Based Refinancing Plan to Help Responsible Borrowers, and he announced this during the State of the Union address on January 24th of 2012, about a month ago. The exact details of the President's proposal are not yet fully clear. According to the fact sheet released by the White House, the new refinance plan is part of the President's blueprint for an America Built to Last initiative. The initiative includes a plan to allow borrowers of non-GSE loans who are current on their payments to refinance under a streamlined program that will be administered by the FHA, and also making further enhancements to HARP 2.0. Under the plan, borrowers with non-GSE loans will have access to refinancing through this new program to be administered by the FHA. The White House estimates that this refinance plan will save homeowners on average about $3,000 a year. And remember the numbers we just quoted as to what you have to get to that number in terms of interest rate reduction and those things. So as announced, the program will be open to all non-GSE borrowers with non-jumbo mortgage loans. The borrower will have to meet certain requirements to qualify, including that the loan must be secured by a single-family owner-occupied principal residence. The borrower must be current on their mortgage for the past 6 months and have missed no more than one payment in the past 6 months. And the borrower must have a minimum FICO score of 580 or greater. The White House estimates that 9 out of 10 borrowers that are otherwise eligible will meet this requirement. The loan also may not exceed current FHA conforming loan limits for the area in which the property is located, and the conforming FHA limits range from around $271,000 in the lowest cost areas up to $729,000 in high cost areas. The President's proposal provides for a streamlined application process. A new appraisal or tax return will not be required. The lender will only need to confirm that the borrower is employed. Whether this new program will impose LTV ratio limitations is not yet clear. However, the proposal indicates that for deeply underwater borrowers, such as borrowers with LTV ratios greater than 140%, the administration is working on a proposal to require lenders to write down the balance of these loans. The administration estimates that the cost of this new plan will be in the range of $5 to $10 billion, and this cost is proposed to be paid for by a financial crisis responsibility fee, which will be imposed on some of the larger financial institutions. Slide 21, additional potential enhancements to HARP, or HARP 3.0, as we may be calling it in the future. The President's plan includes a proposal to further simplify procedures under HARP for the refinance of loans owned or guaranteed by the GSEs, and if implemented, these changes could amount to what we would call HARP 3.0. For example, Fannie Mae currently requires a new appraisal in some situations when a property fieldwork waiver is not available for a loan. The proposal seeks to further eliminate the need for a new appraisal by directing Fannie Mae to use mark-to-market accounting or other alternatives to an appraisal. The proposal also seeks to increase competition among servicers by requiring the same streamlined underwriting procedure for refinances by new servicers and by current servicers. The proposal would open up HARP to refinances to all borrowers, including borrowers with LTV ratios below 80%. The President's plan also includes a proposal to require the GSEs and the FHA to cover the closing costs for borrowers who choose to refinance loans into terms with 20 years or less. This proposal is designed to encourage borrowers to refinance into shorter-term loans to help them speed up the rebuilding of equity in their homes. It appears that some or all or parts of the President's proposed refinance plan will require congressional action and approval before they can be implemented. According to the fact sheet released by the White House, President Obama has called on Congress to pass legislation for a new refinance plan for non-GSE borrowers. The Obama administration has also called on Congress to enact changes to HARP for GSE loans, and although the administration believes these steps are within the existing authority of FHFA, the Federal Housing Finance Agency, it also states that the GSEs have not acted to date. Thus, the administration may be looking for congressional action. I guess I'll just sum up here with a quote by Winston Churchill. During World War II, Winston Churchill said, "You can always count on the Americans to get it right after they've tried everything else." And a quote out of the Washington Post recently had Speaker of the House, Representative Weiner, saying, "One more time, we're going to do this one more time. How many different times are we going to do this?" And I guess the answer to the question is we're going to keep doing it until we get it right. And Brian, we'll turn it back over to you.
Yeah, well, thank you, guys. I mean, that was absolutely amazing information. We've got over 120 questions. So my little, 5-minute appraisal piece, I think is going to be superseded by these questions because I want to get some of these things answered. I hope you guys really enjoyed this. I mean, these guys obviously covered a lot of information, and then we'll make these slides available later as well. The one piece that I think Fed and Jim covered a lot is a little bit of the, is kind of our piece, is that appraisal and AVM piece. That most of these things will be from the desktop, and most of these things we'll get some type of property condition from the lenders that I've talked to. And some of the banks that I've talked to, most of them are even if it doesn't require an appraisal, are going to do like some type of drive-by just to get an idea of the value. And I'm just going to, we got 130 questions, so I'm just going to, Crystal, you there?
Yes, I am.
All right, Crystal, because what I want to do is get, put Jim's information. What I want to do is get, some of these questions asked, just because we've got so many questions that there's no way that, my 5-minute piece, and I'll send you guys an email what I was going to cover, but this is way more important. Crystal, I know you have some questions. Do you have anything that you can, anyone that's asked the same questions over and over again that you can ask Jim and Fed?
Sure,
Crystal,
sure. Oh, sorry, go ahead.
Crystal, this is Jim Milano. Since there's so many questions, I trust there's a way to capture the questions. If you'll capture all of those and send them to us, we'll go through them and try to come up with responses to the most common questions.
Sure, yeah.
Okay.
I'll do my best. I'll definitely do my best to summarize any repeats or anything that I've been receiving. I do know that a lot of questions have been coming in, so you guys have definitely presented us with a lot of great information, because if you didn't, there wouldn't be as many questions as there are. So we definitely appreciate you doing that for us today. For all of our attendees, as you can see, their contact information is there as well. So if I do not, unfortunately, if I am unable to get to your question, please feel free to contact either us, and we will send it in the right direction, or you can contact Jim or Fed, and they will be happy to answer for you. So I'll go ahead and jump right in.
Crystal, just do 5 questions, and then the rest we're going to do. We'll send out, guys. We'll get to try to answer your questions, but just do 5, and then what we'll do is just email Jim and Fed a copy of the spreadsheet with all the questions.
Okay. And for all of those of you that are listening, if you did not receive my direct message during the presentation, this session is being recorded. So all of the Q&A will be there for you to go back and listen to, and a direct link will be sent out to you with the information of how to get back to this presentation. So if you didn't get a chance to take notes, that is available for you. So I'll go ahead and start on the first question. The first question comes from Jack Campolino. He basically wants to know, in a nutshell, there are very liberal guidelines. He wants to know if there will be available to everyone when, sorry, I'm going to have to start from the beginning. He provided a little bit of background info. He said, under HARP 2.0, the October guidelines say that the lender can do a manual underwrite for loans they service, and they can offer loans to folks who have had a foreclosure or bankruptcy or a deed in lieu at a most recent time in standard guidelines. He said things like income and LTV or credit score, as long as it is above 620, are all okay. The question is, will these very liberal guidelines be available to everyone when GU gets updated in March 2012?
Also, to touch upon this, with respect to the underwriting requirements, unless the payment goes up by more than 20%, essentially the requirements are that there must be a benefit to the borrower from the refinance transaction, and the borrower must meet the payment history requirements that we talked about. The additional borrower requalification requirements, including the credit score and the DTI ratio of the maximum cap of 45% and the minimum credit score of 620, those are only applicable if the payment is going up by more than 20%. So that's under the manual underwriting option. I think the question was on the DU Refi Plus, whether these liberal, relaxed, more flexible requirements will apply to the DU Refi Plus. Essentially, under DU Refi Plus, the desktop underwriter will underwrite the loan and will send a message to the lender indicating what the requirements are. And that applies to the appraisal, whether the appraisal waiver is available or not, and that also would apply to this requalification. So if you're looking to refinance under DU Refi Plus, really you have to follow the guidelines and the messages that the lender receives from DU, from the desktop underwriter. I'm not sure if I'm answering the exact question, but that's how this works under the Fannie Mae HARP scheme.
Perfect. Thank you so much. And our next question comes from Dave. He wants to know if a borrower is eligible if he or she resides in their home and is divorced, and the previously jointly owned house is delinquent and resided in by the ex-spouse.
So we're adding a borrower, or we're adding a...
I think, I'm not quite sure I follow, but you're saying you're taking the delinquent borrower off because there was a divorce, and in this scenario, the wife was a delinquent borrower and she's being removed from title?
It looks like the ex-spouse is still residing in the delinquent home, and
Okay.
I guess that's their question. I guess
Okay.
it's still being habitated.
All right, that's fine. So to touch upon this, basically, you can remove a borrower from the loan. I'm not sure why you would be adding somebody to the loan, but you can remove somebody from the loan as long as the remaining borrower or borrowers have been making payments through their own separate funds, from their separate funds, for, I believe that's 12 months, at least 12 months. So that's one requirement. So the payment, the remaining borrower must be making payments from their separate checking account here, not from a joint checking account, in order to be able to remove the other borrower. And also, if you do remove the other borrower from the refinance loan, they have to be removed from the deed as well. So they have to be, they can no longer stay on title to the property. Of course, if we were talking about a death situation, I know that's not the case here, but if the borrower, one of the borrowers dies, the requirement for the remaining borrower to make payments from separate funds would not apply.
Okay, great. Thank you so much for that. And Lewis wants to know if HARP is only for 30-year mortgages or 15-year loans, interest-only loans, etc.
Well, there are a variety of products available that are offered by Fannie and Freddie for HARP refinances. They've added some products as well, but basically the 30-year or less will be the predominant product, I think, and that's because the deregulation, so to speak, of the LTV ratio cap is only going to apply to a fixed rate mortgage of 30 years or less, fully amortizing fixed rate. So if the borrower is deeply underwater, and that's what HARP 2 is intended to expand the availability of the program to deeply underwater borrowers, in order to refinance, if the borrower is more than 125% underwater, you can only refinance into a 30-year or less fixed rate mortgage. So that's going to be the predominant product. ARMs are available, but they're subject to the 105% LTV. And if you're looking at something like an IO or something like that, you have to be very careful there because, as we discussed, one of the key underwriting requirements is that the borrower must receive a benefit from the refinance transaction. So typically going from an IO, interest-only feature, to a fully amortizing loan would be a benefit, but the other way around might not. So you have to be very careful there.
Great, thank you. And our next question comes from Ron. He states that his understanding is that Fannie Mae requires the loan to be owned or guaranteed by Fannie Mae no later than June 1st, 2009. He wants to know if the changes to HARP 2.0 mean that that date is going to be eliminated.
That's not the case, and in fact, it has to be, the loan has to be owned or guaranteed before June 1 of 2009. So if it's June 1, I think the loan would be ineligible, and that requirement has not changed. So they did not remove the threshold for the entry. That time frame remains the same.
Yeah, the policy provision there, the policy reasons is Fannie Mae and Freddie Mac state that, you know, loans on or after that date, June 1st of 2009, was subject to more stringent underwriting requirements that the GSEs had put into place at that time. So they just established that as a cutoff date.
Okay, great. And we'll go ahead and take one last question from Dan. He states, what about clients who are paying PMI? Because it seems this does not apply to them. He has quite a few clients who are paying PMI or have an LPMI loan, and he cannot help them. He wants to know if you have any insight regarding this issue.
Well, in terms of, we did not include a discussion of MI coverage in our slides. We had a lot covered to begin with. There are specific requirements under HARP. To summarize really quick, if a loan is refinanced under HARP and there is no MI currently on the loan, then MI will not be required under the refinance loan. Now, if there is currently MI under the loan, then under the refinance, I think you have to also get MI as well. And I don't think there's relief there, but you know, we would have to double check on that. I don't think this has changed through HARP 2.0. I think this has remained as is from HARP 1.0, but we did not include this discussion. If there's a specific question, we can certainly answer it.
Okay, yes, there are definitely a lot more questions here. We'll go ahead and send those to you via spreadsheet. Don't worry, listeners, we do have your email addresses. It was captured once you registered with us. So we will do our best to get back to you on all of your questions that you had. But thank you so much, Jim and Fed, for your wonderful insight. I'm sure everybody here found it very, very helpful. And Brian, I'll let you finish up with any last words you have.
Yeah, so Jim, Fred, we have about 400 users still on. Give them the overview of the services you guys provide for somebody, a mortgage lender or you know, bank that you provide.
We are a boutique mortgage banking firm. We're based in Washington, D.C. We also have offices in Dallas, Texas, and in Southern California, in Irvine, Newport Beach, California. We give regulatory compliance advice to mortgage lenders, both banks and non-banks, and the vendors that serve them, title agencies, appraisal management companies, servicers. We do a lot of work for servicers right now. And our services span regulatory compliance, giving compliance advice, helping design loan programs, helping folks get licensed, loan disclosures, fee surveys. We do defensive litigation if people get sued by borrowers, or if there are investigations, we defend those. We also do transactional work. So if people are looking to buy other mortgage companies or buy pools of loans, we represent those folks. And we help folks get licensed in all 50 states. We review loan programs in all 50 states, and we do all of the federal alphabet soup, RESPA, TILA, everything else. We're very busy right now with Dodd-Frank implementation, and we're also very busy with defending enforcement actions by regulatory agencies, whether that's the Department of Justice, FTC investigations, state mortgage banking exams, or even some recent exams just inherited by the new bureau that they've taken over from other federal agencies. We do a lot of work with FHA loans. We can help lenders respond to indemnification requests by FHA. So anything in mortgage banking, it sort of runs the gamut.
Okay. Yeah, no, and then you guys are very close with the. Yeah, these guys are the best in the business. So we appreciate you guys so much. I mean, there's over 170 questions now that we have. So we'll be sure to export that to a spreadsheet and get all the questions that we can have answered. And then also we'll be sending definitely a recorded copy of this presentation out to everyone. So Crystal, you want to sign us off?
Sure. Thank you all once again so much for attending. I have already saved those questions in that log, so it'll be a matter of time right before we get it to you. And thank you all so much once again for attending. Have a great day.
Thank you. Bye.